One of the other signs we're watching, the Conference Board's consumer confidence reading saw declines for a third consecutive month. Our next guest says the consumer is slowing and you should consider investing in high quality companies in this environment. As a result, here to discuss is Gargi Chaudhuri, who is head of iShares investment strategy Americas at BlackRock. Gargi, it's great to see you. Thanks so much for being here with us. I want to talk and dig into a little bit more this notion of the consumer and how it is sort of supporting the economic environment. And I'm wondering how closely you're watching that theme and if you're starting to get concerned.
Hi, Julie. It's great to be here. Thank you for having me. Great new space that you guys have back there. So absolutely, to your question, we think that how the consumer behaves over the next couple of quarters will be extremely important for anyone that's watching the markets for a couple of reasons. Obviously, we saw in the Q3 GDP that the consumption strength was a big driver of that 4.9% GDP. So if there's any slowdown on the path of the consumer, that is obviously going to feed into growth. But the other thing that I think has been really interesting is watching the monthly consumption spending and income data. And one thing that I've been paying particular attention to is the drawdown of the savings rate, right? So yes, the consumer is spending, but there has been a depletion of the savings rate down from sort of that 7% pre-pandemic level to about a little higher than 3.5% now. So the consumer feels confident to dip into savings, but how much further can we expect that confidence to last, especially when the restrictive policy rates that we are already at begins to bite? And at the same time, we have some other headwinds, such as, of course, as you guys mentioned, the resumption of the student loan payments, financial conditions tightening, and perhaps, some kind of government shutdown in November.
And Gargi, I'm interested, so these trends, these themes that you're seeing in the consumer, are you seeing them show up during this earnings season, which continues? We've got AMD after the bell. We've got, of course, the big one, Apple, on Thursday. Are you seeing these trends you're talking about highlighted when you hear CEOs and CFOs on the conference calls? What do you make so far of this earnings cycle?
Sure thing, Josh. So definitely on the earnings cycle so far, I think from the expectations that we had coming in, we've sort of been meeting them. But what's been interesting to us is looking at the data. When companies have missed, they've been punished a lot worse than in previous couple of quarters. When I'm looking specifically at companies that are talking about, the shape of the consumer and the health of the consumer, there is some concern that we're getting just around the lagged effect. So it's not necessarily about rates now. It's not necessarily about inflation anymore. We're not hearing that as much, but it's really about concerns around the lagged effects of higher rates and what that might do, which is exactly why, to your point earlier, I think watching how the consumer behaves is going to be really important for forecasting growth, whether or not we want to call it a soft landing, no landing, etc. But I think that's going to be a big driver of growth and actually how we make investment decisions, which is why we favor quality still.
It's so hard to time all of this, isn't it, Gargi? Because we thought, so many predictions thought that things would slow down already. But I know you're looking at quality, which I guess the thinking is it can work even in advance of all of this rolling over, right? What does quality look like?
Yes, what does quality mean? That's a question we get asked a lot. And here we're looking at companies that have margin resiliency, that have free cash flow, that have strength of balance sheet, that have low debts, low leverage. And I think that's particularly important in periods where interest rates stay higher for longer, which is exactly the period that we're in now. So focusing on quality, staying invested. Look, none of us had probably expected the year to have turned out the way it has, but I think staying invested and staying towards the higher quality parts of the market in a sector neutral fashion, we think makes a lot of sense. And I'd say the same for the bond markets. We're obviously looking at the QUAL ticker here, but I'd say up in quality also applies for the bond markets, where especially going into the year end, as investors are looking to perhaps tax loss harvest, take some opportunities where they've had some price negative returns in their bond portfolios and their core bond portfolios, moving moving to quality parts of the fixed income ETF market, such as the 3 to 7 year Treasury bond ETF, which is IEI, which we think, again, makes a lot of sense when we're looking at a Fed that's more or less done in their hiking cycle.
And Gargi, you mentioned how we're heading into year end here. I was wondering if you're in that year end rally camp, Gargi, because I saw Morgan Stanley's Michael Wilson. He is not expecting that. He says chances of fourth quarter rally have fallen considerably, Gargi. He mentioned narrowing breadth. He mentioned falling earnings revisions, talked about fading consumer and business confidence. Where are you on that?
Sure. So obviously the seasonals, as your listeners know, are very strong for November and December. I think a lot of what the market does for the next 2 or 3 months will depend on what interest rates do. If we continue to see rising real rates, if we continue to see a bear steepening in the yield curve, I think it's going to be very hard for the market to continue to do as well as it has done the last few days. But I think if this is near the peak of rates, I think we can possibly see a market that goes up a little bit from here, not massive moves, but sort of getting back to the 4,200 or a little bit higher level, which the market has hovered around for some time. I think a lot of that hinges on the rate dynamic from here on. More bear steepening, I don't think bodes well for equity markets. But in either case, I think investors should be thinking about a little bit longer term than just the next couple of months. And I think that with growth looking solid, slower from here, but solid, I think we're going to do well remaining in the higher quality parts of the equity market as well as the fixed income market for the next 6 to 12 months.
Looking beyond a couple of months. Revolutionary, right, Gargi? Thanks so much for giving us some perspective here. Gargi Chaudhuri, thank you so much. Appreciate it.
Thanks.